Some of you always ask me, Michael, why don't you go and shoot videos in some more affordable areas? So today I am in Santa Rosa, California, and this house that you guys are looking at right behind me is for sale for $655,000, which is a deal for California because it's hard to find a house for under $1 million anywhere near the coastal cities. And guess what, guys? Even though it's $655 grand, most of you probably still can't afford it, because the house payment on this place would be about $4,300 per month. That's with a 20% down payment of $123 grand at today's interest rates. And so that's going to be the theme of today's video of why still 90% of people can't afford a house like this. Now, back in 2004, this house would have cost you $400,000 because that's how much the last owner bought it for, and now they're selling it for $655,000. So not a crazy amount of appreciation, but definitely a good amount. And as you guys can see, there's a ton of road work happening literally right next to this house, which there's no way I could have known ahead of time. So I'm gonna walk over to the other block over here so we can have some peace and quiet. One of my viewers, Steve, has always sending me these great stories, sent me this one today about why 90% of people can't afford a house today. And this story has some great points in it that I'm going to go over with you guys that pretty much just sums it all up, guys, and kind of gives people the overview of why real estate is so ridiculous now. So the first thing is that the US economy, and really the world economy now, runs on what you could say is called a bubble economy. And unfortunately, anytime there's a bubble economy, 90% of the wealth that's created goes to the top 10% of already wealthy people. And that's just kind of the way that these bubble economies work with their boom and bust cycles. Now, if we take a look at this chart, the first chart shows that the top 10% own about 85 to 95% of all income producing assets in the United States, okay? And those are things like business equities, stocks, bonds, securities, non-home real estate, meaning second homes or income producing properties, basically investment property. So just think about that for a minute. 10% of the nation's wealthiest folks own 85 to 95% of everything already right now. So that's already astonishing, right, when you think about it. And this has all been made possible because of our bubble economy. And now if we take a look at this second chart here, it shows that the household net worth concentrated in the top 10% has soared above GDP in this bubble economy, and basically creating about $55 trillion out of thin air, and 90% of that $55 trillion went to the top 10% who are already wealthy. Now, if we take a look at this chart again, if household net worth were to track with GDP, it would currently be around $90 trillion. However, because we are in this bubble economy, it's actually closer to $146 trillion. And this is all possible because we have the Federal Reserve, and throughout the world, we have reserve banks that dictate what interest rates are. And because these reserve banks can dictate interest rates and also create monetary policy and print money and destroy money, they have the power to have a massive influence over our economy. Hence the reason why we're seeing right now we have over 7% mortgage rates, and 90% of people can't afford a house like the one we just looked at, $4,300 a month with $123,000 down, guys. That is unbelievable. And to give you guys just an idea of how far out of whack this bubble economy is right now, okay, we have $55 trillion of household wealth that's over GDP right now, and it should be around 90 trillion. But to put that in the perspective of how big the bubble is now compared to the 2008 bubble, back then the household wealth was only about $5 trillion above GDP back then. So that is an astonishing difference. We're talking from $5 trillion to now $55 trillion difference in the span of the last 15 years, guys. That's insane. So what you have from this is you have a lot of wealthy people that basically hold the lion's share of all the wealth and can afford to invest hundreds of millions, if not billions of dollars sometimes, into real estate and other assets. That's why you're seeing now that everything is at an all-time high. You see home prices at all-time highs. You see stock market prices all-time highs, because they have to put this money somewhere to put it to work for them, which is the smart thing to do. And if you are somebody who actually can get in on this, say you own a couple investment properties or you've been investing in the stock market the last 10 years, you're able to actually ride the wave up with this as well, relative to the amount that you've invested in it. So this can definitely benefit the average Joe, but only if you are investing in these things to begin with. Now, the interesting thing is, since we're talking about how this is all based on a bubble economy, that we really didn't have these major boom and bust cycles in housing, at least not that much, until around the year 2000. We had the dot-com bubble, okay? And then what happened is that bubble popped, and then the Fed lowered interest rates, okay? It went from 6.5% down in the summer of 2000 down to 1% in the summer of 2003. So over the span of about 3 years, it went down to practically nothing, 1%. And from 2000 to 2005, interest rates remained low, around 3%, all the way into 2005. And as you can see, that low interest rate environment allowed the next bubble to form. Now, by mid-2007, interest rates were back up to 5%, and the housing bubble began to burst, kind of like what I think we're starting to see happen again right now. But then once again, the Fed decided to start lowering rates, okay? That's what they do. Every time you see them lowering rates, guys, it's because things are not going well. And that's what we saw happen back in 2000. We saw it happen in 2008. And it's what I believe we're going to see happen again, probably into 2024, whenever they finally decide to start cutting rates. Because by mid-2007, you had 5% interest rates. And by December 2008, it was basically zero. So the huge rate cut really fast because the economy was in big trouble, and that's when you saw the entire housing market crash. And this is what I keep telling people also. When the Fed starts lowering rates, this is not going to be good news for you unless you are in a financially healthy position where you could take advantage of it, because everybody thinks buyers are going to flood back into the market whenever interest rates drop. Except the problem is, when interest rates drop, it's because the economy is flashing red. Now, like we mentioned earlier, the top 10% own 90% of the wealth. After the 2000 bubble burst, and we had the run up to the 2008 housing market crash, this is when real estate started catching the eye of more investors. This is when more people started realizing, hey, I have all this extra money, all this extra wealth, I got to start pouring it into something right now because I just have too much of it. And so they look towards real estate. So not only you have more people with lots of money starting to keep their eye on the ball with real estate back in the early 2000s that helped run up to the last bubble that we were in, but you also had all this crazy shenanigans going on, like ninja loans, you had adjustable rate mortgages, predatory lending, and then you had basically garbage loans being bundled up into mortgage-backed securities, right? That ended up being a complete failure for the financial system. And all of these things combined is what basically brought the housing market down back in 2008. So hopefully you're starting to see how these bubbles can easily form thanks to the monetary policy that the Fed puts into place. Because you see, all these investors are driven by what the Fed does. Because when the Fed drops interest rates to near zero and borrowing money is cheap, everybody wants to get in on it. And now, because of the internet and YouTube and everything that we have now, more and more people are aware of this than ever before, and that's why you saw so many people jump into the housing market when interest rates were low after they knocked them to the floor during the pandemic, because people started to wake up and realize, I might not ever have a chance to borrow money at this rate ever again. And that's basically what created the housing frenzy that we saw over the past few years. And it wasn't just the interest rates going low. You also had massive stimulus pumped into the economy in the form of stimulus checks, EIDL loans, PPP loans, and the myriad of other things that they came up with during this time, putting extra money in people's pocket, while simultaneously the Fed literally doubled their balance sheet in terms of how much they were holding in mortgage-backed securities. So they literally added $2.6 trillion of mortgage-backed securities during this run-up. So this ends up being all artificial stimulation from the Fed. And for anybody who was paying attention during all this craziness, obviously it wasn't just the real estate market that got inflated into a huge bubble. It was the entire economy, hence our bubble economy. And of course, stocks and bonds were not immune to this. In fact, if you look back, the S&P 500 in early 2009 was only 666 points, right? And fast forward to early 2020, it went up to 3380, and now it's well over 4,000. So things have gotten out of control, essentially. But to make matters worse, the vast majority of all these gains that we're talking about went to the top 10%, or you can narrow that down to about 13 million US households. Now, it's estimated that the upper middle class is probably around 12 million households throughout the United States, and typically upper middle class folks will own more than one home, whether it's just a second home, investment property, whatever, but they'll have their primary residence and maybe a vacation home somewhere. And so as people in this wealth category saw their portfolios go to the moon during this whole pandemic stimulus, this pretty much gave the green light for people like that to go on the buying spree. And that's when we've seen so much money pour into the housing market. And the funny thing is, guys, like a lot of people think that all of the investors that bought during this housing cycle were all the institutional investors, you know, BlackRock and, you know, all these other companies like Open Door that try to flip the homes. They think that they're the ones that bought up all the homes. But in reality, mom and pop investors are actually responsible for the lion's share of the amount of investment into housing over the past several years. And in one way to kind of show just how far we've come along in terms of housing affordability and how bad it's gotten is back in the mid to late 90s, you could have mechanics, librarians, electricians, people that have regular blue collar jobs. They could actually afford to buy a modest home in the San Francisco Bay Area where we're at right now. Well, Santa Rosa is not really the Bay Area, but you know what I mean. Down by where I'm staying is extremely expensive now. But if you fast forward to today, there's no way anybody with one of those careers could afford a home in the Bay Area. Not even close, guys. Even if you make, you know, multiple six figures a year now, it's hard to afford the home prices there, especially at these interest rates. And then when you have people that bought these properties, for example, back in the mid to late 90s for, let's say, $200,000, I see this all the time in these Bay Area home examples. You know, people bought for those prices back then. Fast forward to today, that same house they're selling for $2.83 million now. And so that is a massive amount of wealth accumulation that essentially is what you could call unearned wealth. Not meaning that, you know, they don't deserve it, but more like the house was the one just making all the money due to the run up in the markets. It's not that the people don't deserve it, it's just that they didn't have to work for it, is what unearned wealth essentially is. Now, this house is what you would call a coming soon listing. It's not listed yet, but they're trying to drum up hype in the neighborhood by putting the sign in the yard, and they have the pod in the driveway here, making it all look like it's getting ready to hit the market. Anyways, Redfin estimates it would sell for around $655,000. But when we look at the history of this house, check this out, guys. This is what happens when you buy in a bubble, just like we're talking about. They bought this house in December of 2006 for $475,000, and only today, fast forward 15 years later, they're selling this house at hopefully a profit when they sell it for $655,000 or around that price, right? But that's how long it takes to recover and actually get some money out of a house if you buy at the wrong time. And I see many examples here, even in this area, guys. You see houses that sold for 40 grand back in the mid 60s or early 70s, and now these houses are, you know, $600,000. And so when you have all this inherited wealth and unearned wealth, for example, say your family owns like 2 or 3 investment properties that were purchased 30 years ago for 30 grand, and now all those properties are worth well over $2 million, and you want to liquidate one of them, you only need to sell one. You have $2 million there, which allows people like that to go and buy less expensive real estate in other areas of the country for investment. And that's why you saw so many people jumping in the market and buying during this time, because with the Fed stimulus on top of that and low interest rates, if you had $2 million, you could have easily bought 10, 15 investment properties across the country if you leveraged it out and only put 20% down. And so now you can start to understand it's not just the average person that just wants to buy a house that made all this so expensive. The average people are partly responsible for it, but the massive amount of wealth that was already built up in the background that just needs somewhere to go and can't just sit in the bank, all poured into real estate, poured into the stock market, and that's why we see this crazy bubble that we're in right now. And then the problem is, this makes areas that used to be affordable no longer affordable. When you got someone with that excess $2 million going around trying to buy up 10 investment properties in cheaper areas across the country, well, now it makes those areas that used to be more affordable less affordable, because now there's a lot of investor activity taking place. And one area that you can look at as a great example of how this worked out in real life is Florida, guys. Like, Florida has absolutely skyrocketed basically everywhere when it comes to prices since between the last housing downturn and now. And as a Florida resident, somebody that has lived there for 15 plus years and has seen it with my own eyes, it is just astonishing the amount of money that has poured in the form of investment. We have probably more foreign investors in Florida than any other state in the country. Combine that with domestic investors and people that actually want to live there and need a place to live, it made prices go absolutely berserk. And I know prices went crazy everywhere, but not to the tune that a lot of cities in Florida have when you look at the percentage of increase that we've seen there. And so basically, this bubble got inflated so high, it has created a new class of wealthy Americans. And we're talking millions of households, like we said before. Literally, probably it's estimated to be about 13 million households that have plenty of wealth to go around. And when people have this much wealth, see the values of their properties skyrocket, it basically gives them even more incentive to invest more into real estate, just based on the appreciation factor alone. Because a lot of people think that when you see that level of appreciation, that it's going to keep going forever, which is not actually the case, but a lot of people think it is, especially if they're not experienced with investing in real estate or have really tracked any market cycles in the past. And so basically, all of this has pushed us into the new bubble that we are in right now. And this chart that you're looking at can show you just how extreme this bubble is today compared to the previous housing bubble. And this is my argument with people, and how I don't understand how people think it's not going to come down, guys, because there's no way this bubble can be sustained. There really isn't, unless we have massive Fed stimulus once again, which always ends up creating the next bubble, right? But now we have this new problem called inflation that's continuing to rise. And so if we are going to see this bubble continue to go, we need to see further Fed stimulation, not tightening. So the Fed is doing basically the opposite of what creates the bubble, okay? And historically speaking, when they change their path, when they change their mind and decide, oh, it's time to start cutting interest rates, that will likely be because things are not going well in the economy. And that's when you're going to start seeing everything collapse. You're going to start seeing prices come down, because inventory will probably rise dramatically. Because here's the thing, if the economy is not doing well, then one of the signals that they use to measure that is unemployment. And historically speaking, as unemployment goes up, so do mortgage defaults. And it's not just regular people that bought a house that might default on a mortgage, guys. Remember all the investors we just talked about? Well, any of these investors that are highly leveraged into the market, somebody that took those $2 million, for example, and bought 10 different properties, say that person experiences some kind of financial distress. They might not be able to hang on to those investment properties, especially if they're not cash flowing at a very high margin. If they're only making a few $100s a month, depending on when they bought, that could spell disaster for someone like that as well. And instead of them selling one house, maybe they got to sell 5 houses. And then you throw in the average Joe that might need to sell because they lost their job. You can easily see how inventory can start to go up pretty rapidly. And since it's so low right now, and we're still seeing prices come down a little bit, then you know for sure that if inventory even goes up just a little bit, guys, just like 20-30% from where it is now, you're going to see prices come down dramatically. And so when you add up everything that we just talked about, this is why 90% of people cannot afford a home today. Because if you're not in that club, essentially, that we described, where you were able to take advantage of this wealth bubble, if you're not somebody that was on the receiving end of this crazy bubble, then you're not in the club, guys, unfortunately. It's this mentality and it's this type of thing that makes people think, well, real estate is always a good investment and real estate always goes up, because in the long run, that actually is true. Because if you look at real estate over a 20 or 30 year time frame, then you're pretty much never going to lose money. But the problem is, a lot of people don't look at it like that. People look at it as speculation. People look at it as, I'm going to buy this place and I'm going to make a ton of money Airbnb-ing it, or I'm going to buy it and I'm going to flip it for, 20% more than I just paid for it yesterday. And that worked for a little while when we were in this bubble frenzy, but now that all that's over with, so is that behavior. That's not going to be able to go on anymore. And this is why I'm just saying people need to be cautious right now, because anybody who's still investing today thinking that we're going to see the same results that we saw over the past 3 years could be delusional, guys. Like, is it possible? Sure, anything is possible. But with the direction that we're headed right now, the odds of that being the case are extremely low right now. And of course, it does depend on where you live. Real estate is local. Like, for example, in Miami, prices are still up like 7 or 8% year over year right now, which is totally insane. But at the same time, there's areas here in California that are down double digits. In fact, one of the areas that I'm just looking at right now by where I'm staying, Corte Madera, California, it's down 44% year over year, guys. You don't believe me? Look at this chart from Redfin. 44%. The real estate is down year over year. And I'm going to get into why I think that's the case more in another video, but it just goes to show you that, yeah, it's not like things are coming down everywhere. There are places that are still rising in value, notably the Northeast, the Midwest, parts of Florida, like Miami, for example. A lot of Florida, no, but parts of Florida are still going crazy, guys. So there are places where prices are still going up. But if you're somebody looking to, take advantage of this wealth bubble, sorry to tell you, but we've already reached kind of like the limit of how far the bubble can go before it gets popped. And I think it could pop any day now. Most likely, we're going to be looking at some point in 2024 when the Fed decides it's time to start lowering interest rates because things are getting too bad. Unemployment's going too high. People are not being able to pay their bills and things like that. That's going to spark the Fed to start lowering rates. And when they do that, that's when the yield curve will uninvert and we will go into an official recession, and you guys are going to see everything start to come down, because that's just the way it goes. This is the cycle that we have seen time and time again, and I have basically zero doubt that that's the same cycle we will see again this time. So if you guys enjoyed this video, make sure you subscribe to the channel, and if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.